what do I think are the best strategies for investing in real estate in today's market? That's a question I get a lot. And there's so many ways to make money in real estate, whether the market is up, whether the market is down, whether the market is flat. And different strategies tend to work better in different types of markets in different places in the country. But the fundamentals pretty much always remain the same. You want to have positive cash flow, you want to buy low, sell high, et cetera, et cetera, et cetera. Pick the right properties, manage them properly, do the right repairs, et cetera, et cetera, et cetera. So I think the three best strategies, if I was going to advise someone new or someone getting back into real estate in today's market, this is what I would recommend. Rentals, single family rental properties, wholesaling and flipping houses, and lease options. So wholesaling and flipping, they kind of go together, but I'm going to explain some variations of that. Single family rental properties in decent neighborhoods and lease options. So first, before we get into those three strategies, a common thing that people say is, well, the market is saturated with investors. There's no deals anymore. It's really hard to find a deal. And I say that's nonsense. The multiple listing service that the real estate agents use, that has very low inventory. So for example, in my market in Denver, Colorado, in 2006 or so, we had 25 to 30,000 homes for sale at any given time. That's a fairly normal number. And right now we're down under 5,000 homes, so 80% less. Now, there's not more investors, there's just less homes, so it seems like there's a lot of competition when there really isn't. You're just fighting for what is available on the multiple listing and working through a real estate agent. Not that I recommend you don't do that, but if that's your primary focus, you're going to get disappointed really quickly. So you have to go out and hustle and find deals in places other than the places that everybody else is looking. Okay, so first thing you need to do is you need to have a marketing plan. Like every business, you have to lay out, what am I going to do every month, every week, every day, every quarter, every year, and put it in writing. And there's so many different ways. I'll describe a few in a moment, but ways to market to find motivated sellers, because that's what we're looking for. We're not looking just for any house for sale. We're looking for motivated sellers, people who have a real reason. They don't want this house and they don't want it in a bad way. They got a bad relationship with their house. It's not necessarily the house that has the problem. It's the relationship with the house that's the problem. And when people get frustrated, upset, they tend to not use their brain. They use their emotions, and they're willing to pretty much do anything in some cases just to get rid of the house, get rid of their problem. So we're in the problem solving business. Solve the problem, you make money, okay? Use multiple methods of marketing, not just one. So some people just do mailers, or some people just put little signs in the ground that say, I buy houses. You see them all over the place. In fact, they're like this big. I want to get a little sign that says "Me too" and my phone number. Wonder what they think of that. A lot cheaper than the big sign. And have an effective way of handling the leads that come in, following up on them, because a lot of people will talk to someone once, they don't seem that interested, and they throw the lead away, and that's crazy, 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 crazy. People's motivations change over time. 6 months of no payments, no income coming in and making payments on a house, that'll change your motivation over 6 months. A break-in, a busted hot water heater that floods the place, things happen. People change their motivation. So you should be following up on every single lead, every single month, maybe even every single week. Okay, so make sure you have some way of following up on these people. Make sure you have a very good script, too, for when people call. You should have a written script. I do. Every good investor has one. I have an excellent one, in fact, that I've developed over the years from doing handling outbound and inbound calls with motivated sellers. And besides the regular, run-of-the-mill information like their name, phone number, property address, bedrooms, baths, yada, 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 you want to really ask the right questions to elicit what's the seller's motivation for selling. Because if you don't get to that, you don't know what the problem is. Can't solve the problem, can't make a deal. If you're just going on price, you're not likely to make a deal. So you got to find out what's the root cause of why they're selling, and that's going to take getting them to trust you, open up to you, tell you the real story behind, the front story, which is I want to sell my house. No, that's not the story. The story is something like, well, I got a divorce, or I got a job transfer, or I'm 3 payments behind, or I just inherited it and I don't want to deal with it, and et cetera, et cetera, et cetera. You want to find what the real problem is. So when you make your offer, it's a solution to the problem. Okay, here's some suggested ways that you can market to find motivated sellers. I mentioned earlier, mailers. That is, mailing out letters to people that belong to a particular group. You can shotgun one neighborhood. You can go broader, but specific types of owners, like people who have owned it more than 10 years, people whose address does not match the house address, meaning their tax billing address at the county is somewhere else, maybe out of state, even better. So they're an absentee landlord living out of state, tend to be more motivated sellers. Real estate brokers and agents, you can get email lists for them and broadcast email that you're looking for deals. Going to your local real estate investment association meetings called RIAs. Just if you haven't been to one or you don't know one in your area, just Google your city and then put at the end REIA, RIA, Real Estate Investor Association, and you will likely find one. Also, you want to Google, if you're looking to buy for rentals, for example, or buying to fix and flip, you're not wholesaling, Google wholesale properties, your city, and you will find websites of other wholesalers who can wholesale to you. Okay, and then the fifth one, which by the way, I have dozens and dozens and dozens of ways, creative ways to find deals in my courses, but I just want to give you a highlight of a few of my favorites. One of my favorites is calling people on Craigslist, not for sale by owner. Those people are insane. Have you ever called those people? Yeah, I think it's worth 300 and I want 400. Right. In your dreams, buddy. You're looking for rent by owners. If you're looking to buy rental properties, why wouldn't you look in the place where rental properties exist? Call landlords, tell them you're not looking to rent the place, but you're also a landlord and you're looking to pick up some homes for your portfolio. Are they interested in selling? Yes, no, maybe. Okay? So hopefully you get a yes or a maybe. I mean, there's 3 types of landlords. There's landlords like me who intentionally rent properties and advertise them as such, or my property manager does. The second kind is what we call the accidental landlord, someone who's renting because they don't know what to do with it. They couldn't sell it, they live out of state, they just inherited it, it's a divorce, et cetera, et cetera. And the third type is what we call a don't wanter. That's someone who's really motivated to sell. Now you'll notice in all 3 of those categories, none of them are particularly listed for sale. So you wouldn't find them in the traditional places with a real estate agent. That's why I said you have to look in places that other people don't look. Those people are candidates for selling, but they're not necessarily advertising it for sale. Does that make sense? I hope it does. All right, time for a Marco Rubio moment. All right, so let's talk about the 3 ways. We talked about rentals, wholesales and flips, and lease options. Now, rentals are, I have to give you a formula to explain what I mean. There's not really a hard formula in numbers that I can give you, but I can give you a checklist that as many of these factors as you can check off makes this a good rental property, okay? So the acronym that I'm going to use is called CLEAR, CLEAR, C-L-E-A-R, write it down, CLEAR, C-L-E-A-R. The C stands for cash flow. So if you bought this property, typical way, 20% down, bank loan, There are other ways to do it, which I talk about on my website and my other videos, but let's say the traditional 20% down, go to the bank, get a loan for the rest. Can you cash flow this property in this neighborhood under those terms? And if the answer is no, you're probably going to look away from that deal, okay? And if your mortgage payment is $1,000 a month and you can rent it for $1,000, that's not break even, because you've also got repairs and marketing and things that wear out, et cetera, property management, accounting fees. So you want a bigger cushion there. I'd say at least 20% cushion. So you'd have to rent it for at least $1,200 a month if your payment is $1,000, and that's barely breaking even. I think it should be closer to $1,400, $1,500 a month. If you're putting 20% down and getting an interest rate on a 30-year mortgage with a bank at somewhere around 5%, 5.25%, you should have no problem in the right neighborhoods. You see, very expensive homes and very cheap homes are not the places to look. Very expensive homes, what happens is, as you get higher in price on homes, the concurrent rent levels off. So it's a point of diminishing return. So for example, if you were to buy a $100,000 house, and I know people watching in California say, yeah, right, where am I going to find that? Let's say it's in Indiana. $100,000 house, just follow the math. $100,000 house, your 20% down is 20 grand. $80,000 mortgage is probably going to run you about $600 to $650 a month, depending on your taxes. And that's all inclusive: principal, interest, taxes, insurance, PITI. So if you rent it for $1,000, you're making $350 a month, which is more than that 20% cushion. Does that make sense? Now, if you looked at $1 million home in that same area, $200,000 down, you're not necessarily going to cover the mortgage, which is going to be somewhere, doing the same math, somewhere in the $6,000 a month range. It just won't rent for $6,000 a month. So you're potentially losing money. And the reason is because there's a smaller pool of renters for a high-end home that can afford that, whereas there's lots of people on cheap homes. Now, I said you don't want super cheap, like ghetto stuff, where you have to carry a shotgun or, or similar to collect your rents. You want a decent working class, middle working class neighborhood, so lower middle class. Decent neighborhood, little older homes, maybe, but good people. They have jobs. There's some crime, but it's not gang-ridden. That's the type of house you're looking for. We call these bread and butter homes, or starter homes, some people call them, because usually it's the first house someone would buy. 3 bedrooms, 1.5 bath, 2-car garage, little ranch, something like that. Okay. So cash flow, you got to make sure you've got some sort of positive, or at least break even. Because in the example with the $1 million house, if you put $200,000 down and you didn't have, even if you broke even, you've got $200,000 invested. You're not making anything unless it's a neighborhood that appreciates 10% a year. Well, that's different. Okay, but for the most part, you want to stay in the lower middle working class neighborhoods that are close to shopping and schools, have reasonably good schools, and have easy access, and they're not too old. When I say not too old is, I'd stay away from under 1940. Just a lot of problems with houses older than that. My preference would be 50s, 60s, 70s. Okay? So that's C, the clear. L is leverage. Leverage. So can you leverage the property? Meaning you don't have to buy cash. Can you put 20% down and get a loan from a bank? Can you convince the seller to take terms? Meaning the seller might carry all or part of the purchase price as a seller carry note, which would allow you to put less than 20% down, and that's better leverage. The more you leverage generally at reasonable interest rates, the higher return you get on your money. That's just a mathematical formula. It's nothing complicated. The less you put down, the more return on money you make. Even though you make less cash flow, you make better return on your investment. So those of you who say, I want to buy cash, or I want to put 50% down because I don't want to have to worry about negative cash flow, that might not be the smartest thing to do. You're not going to get the highest return on your money. Okay? The E is equity, and that means are you buying the property with built-in equity? So when I said $100,000 property, I'm assuming that it's worth more than 100. You don't want to pay full price. You want to get some sort of discount. Or is there a way to create equity? Is there a basement you can refinish, put some rooms in there and get more rent? Could you build a garage and then convert the existing attached garage into a third bedroom? Those are opportunities to increase your income, which will increase your equity in the property. Okay? The A is appreciation. Now, in Indiana, as opposed to, let's say, San Francisco, you're not going to get the same appreciation. But then again, in San Francisco, it is impossible to buy a house in San Francisco proper and rent it for your mortgage payment. It's going to be negative. But, like I said, if you buy $1 million home and it appreciates 10% a year, which is $100,000, you could theoretically lose $10,000 a year and still be coming out ahead. I wouldn't recommend that for beginners. But if you can get in a neighborhood that has, for the next 10 to 15 years, good prospects for appreciation. Is there a Walmart coming in? Is there a new big employer coming in? Is the city renovating the area? Are they policing it more for crime? Is there a Starbucks just opening up? You know, usually there's a natural progression of a neighborhood. You take a really old, bad neighborhood, you put up signs that say historic district, right? And then the cops clear out all the drug dealers and the prostitutes. An art gallery opens up. A couple of gay couples move in. Starbucks opens. It's the happening place in town, right? So that's what you got to look for, you know, possible appreciation. And then that's why I would avoid buying really low-end properties, especially in really low-end cities like, no offense if you live there, but Detroit. Indianapolis is a nice city with stable economy. Detroit, not really. Some people think it's going to make a comeback. I don't think you should risk it. That's my personal opinion. And so we have clear C, L, E, A, and then the R is the most important one that you want to balance against the other four factors, and that's called risk. Risk. Not what's the best scenario, what's the worst scenario. Can the neighborhood turn? Can they pass new laws that would make it unavailable to do certain things you wanted to do, like raising rents? You know, they put rent control in. You expected to be able to do a certain use for the property that now you can't do. Maybe you have an adjustable rate loan and then interest rates spike. Those are all risks, and you want to balance those risks against the reward, the CLEA, the cash flow leverage equity appreciation. Okay? So that's what I want to say about rentals for now. On another episode, maybe I'll spend a whole hour on that, but you know, that's the basics, and I think that's where you should be looking as one of your investment strategies. Number 2 strategy would be flipping. I said wholesaling and flipping, but I'm going to go with flipping first before I go into wholesaling. Flipping is what you see on the TV shows, but it's not really reality. Those aren't reality TV shows. Those are fake TV shows, okay? Those are scripted. Buy a house, fix it up, sell it to an owner-occupant. That's flipping. I wrote about that in my best-selling book, Flipping Properties, and my new book, The Business of Flipping Homes, which you could find on Amazon.com and on LegalWiz.com. You know, it's a pretty basic formula. You want to buy the property at a cheap enough discount that with your closing costs and your holding costs And if you're borrowing money, money costs, your fix-up costs, permits, utilities, brokerage fees on the sale of the property, and still make a reasonable profit. What's a reasonable profit? I say no less than 10 to 12% of the selling price, the reselling price. So if you buy it for, let's say 120, you put 30 grand into it, so you're in for 150. You sell it for 200 minus broker fees, minus closing costs, et cetera, net in your pocket 20 grand, that's acceptable. Anything less than that, you're really cutting it close. I know some people do it, but they are experienced and they have a crew of workers and they have everything down to the dime figured out. But the average investor shouldn't do that. You should work on at least a 10% margin. And frankly, builders don't work on much bigger a margin than that. But they've got the system down to find it, develop it, build it, and sell it. And they've got a team of professionals that know how to do it exactly by the book. Most people don't know how to do that. So stick to that at least 10% profit. Now, wholesaling is when you find a deal and you sell it to another investor who's then going to fix and rent or fix and flip. Now, most people think of wholesaling as I find a junker property. That's what they tell you in those seminars. First they say, go get a real estate agent and look on the multiple listings for bank-owned properties, make lowball offers, which never get accepted. And even if they do, you're going to try to wholesale that to another investor who's going to fix and flip it. And that's a losing strategy in this market. You want to use some of the other strategies I talked about, finding deals, but don't just look for wholesaling fix and flips. Look for wholesaling rental properties. There are far more landlords than there are flippers in this market. So if you could find a reasonable deal that would make a good rental property according to the clear formula, you could wholesale that property to another investor for 5 or 10 grand money. And it's finding the deal is the hardest part, I'll admit, but the logistics of once you have it under contract, what you do is you assign your contract to another investor. So you sign up a contract under the terms and price that you agree to, you find another investor who wants to buy it from you, and then you assign your purchase contract. It's sort of like endorsing over a check. Someone writes a check to you, you endorse it over to Fred, Fred cashes the check. Same thing with a contract. Your right to purchase under the contract, unless it says otherwise, is assignable. So read the contract carefully. If it says you may not assign this contract, guess what? You can't assign this contract. Okay? So make sure there's no clause that prohibits it, and then you do your assignment. So we've got flipping, we've got rentals, and we've got wholesaling of either one. The third topic I wanted to talk about was lease options, and I saved a little more time for this one because it requires a little more explanation. Now, most of you know what a lease is. It's a rental agreement between landlord and tenant. Now, an option agreement is a right to do something. In this case, a right to purchase, not an obligation to purchase. It's your right to do so or not to do so. So the seller is bound, the buyer is not. The buyer has the option to proceed or not proceed. If the option is not exercised, according to the option agreement, the buyer loses whatever consideration or money that they put up to obtain the option. Putting the two together, a lease with an option gives you a lease with an option, lease option. So going back to our landlord don't wannabes, the accidental type, and especially if you look for an ad that says for sale or rent, you should be calling these first because they really want to sell and they don't want to deal with it as a rental. Okay, so you call them up and you say, look, just very straightforward. My company will do is we will lease it from you with an option to purchase. We will sublet to a tenant who will pay us rent at a higher rate than we're paying you, and we make a monthly profit. It's okay to say to the seller you intend to make a profit. Unless his name is Bernie Sanders, I don't think he cares. If he's motivated, whatever, as long as he's got enough money in there to pay his mortgage every month. So that's one way you're going to make money. You want an option to purchase the property at a minimum of 10% below its current market value. And you want to have that option for at least 2 to 3 years. Because what's going to happen in the next 2 to 3 years? Rents will go up, prices will hopefully go up, and you will give your subtenant an option to purchase at tomorrow's price in the future. So if it goes up 10% in 3 years, and you have an option to buy it 10% below, you exercise that option from the owner and simultaneously sell it to the subtenant at a 20% spread. 20%. That's pretty darn good on a house you don't even own. So just to sum it up again, what we're going to do is lease a property with an option. Let me give you some numbers so it makes more sense. We'll go back to our mythical $100,000 house. Just easy round numbers. The mortgage payment is $650. You tell the seller, I'm going to rent it from you for $650 a month, and that'll cover the mortgage. You then advertise it for rent to own. Okay? Tenant/future buyer contacts you. You show them the home. It's not going to work if the seller's living there, by the way. It's got to be a house that's vacant. Tenant likes it. You sign an agreement with the tenant that you are going to sell it to them for a price of X over the next 3 years if they exercise. They don't have to either. If the market goes down, they may walk, and then you can walk too when it comes to the seller once your 3 years is up. So it's actually, in some respect, less risky than buying a home and putting a 30-year mortgage in your own name. It's not only a hedge against appreciation, but depreciation. Think about that. So let's say the price that you agreed with the tenant was $110, and that's good for 3 years. Now, it may go up more, it may go up less. That's the risk that the subtenant takes. They're going to rent from you, pay you $1,000 a month. Oh, by the way, when you make the deal with the seller, you're going to give them first month's and maybe last month's rent. You're not going to give the seller $10,000 for the option money. If they want substantial money, you know what that means? They're not motivated. Go milk another cow. Okay? So typically in a rental situation, it's first and last, or first and security. With the subtenancy, however, you're going to treat it a little different. It's a rent to own, not a rent, and you're going to ask for pretty much as you can get down. Typically, it's about 3 to 5% of the purchase price. On a $100,000 home, that's $3 to $5 grand. Now, that money is non-refundable from the tenant. That means as soon as they give it to you, you don't have to escrow it, you could spend it. It's yours. Because if they buy the house, you get to keep it. If they don't buy the house, you still get to keep it. It's either way, clearly spelled out in writing, so they understand, okay? Then you're going to make a spread every month. You're going to bring in $1,000, and you're paying out $650 to the seller to pay his underlying mortgage. Actually, I know people are going to ask me this already. Do I pay the seller or do I pay his bank directly? I don't want to get too far in the weeds, but the short answer is you pay the mortgage directly so you know it gets paid. And then there's a spread there of $350 a month. Now, as we said earlier, you have expenses sometimes, so it might not be exactly $350, but if you can make $3 to $5 grand up front, a couple $100 a month, and then another 20 grand at the end of the lease option or at whatever time the tenant decides to exercise it, that's a pretty good deal, right? That's a pretty good deal. And it works very well in today's market because we're on the appreciation curve in most markets. It doesn't work so well when the market's declining because you'd have to basically get the option at 30% below market and sell it to the tenant at 15% below market. And a lot of people don't have that much equity. So this is going to work real well in a lot of scenarios. And again, look for those ads for sale or rent on places like Craigslist. That's where you're going to find deals like this. Okay? So let's review what we've covered so far. We talked about, the most important thing, me. If you just joined, Bill Bronchick. I'm an attorney and investor with over 25 years experience, host of the website LegalWiz.com, LegalWiz.com, where you can find hundreds of great articles on real estate, videos, my quick tip blog, as well as a free, absolutely free with the triple E, real estate investor crash course. You can sign up there at LegalWiz.com. We talked about the 3 preferable or effective real estate investing techniques in today's market. And those are rental properties, single-family homes, wholesaling and flipping. That's buy, fix, and flip, or wholesale a property as a fix and flip to a fix and flipper, or wholesale it to a landlord for a fix and rent. Okay? And we're just talked about the lease option. Now, specifically, there are 8 different ways to lease option that I teach in my programs. You can find those at LegalWiz.com. Click on the store. And I have programs on just about every topic. You can check it out. They're mostly online courses. I figure if you're online, you want an online course, you don't want it shipped. So that'll be good for you. But lease option, this specific type of strategy is what's known as a sandwich lease option. Sandwich, which means you're basically the meat. You're going to sandwich yourself between the owner who's motivated and wants to rent it and ultimately sell it, and then the subtenant who wants to buy a house and they want to live in it now, but they can't close for another year. And there could be a lot of reasons for that. They just moved into town. They want to rent, but they want to buy, within the year. Maybe they had a bankruptcy and they need an extra year or 2 for that to clear off their credit. Or they have some other credit problem that they need a year or 2 to fix their credit. Or they don't have enough income right now and they're expecting a big raise, or they're expecting an inheritance, whatever. There's a lot of reasons why you'll find those buyers. They're very easy to find. The sellers are typically a seller who's got not a lot of equity. So in the $100,000 house example, if they owed 85, they could list it with a real estate broker and minus the closing costs and the broker's fees, net a few grand after paying off the mortgage. But if you offer them a solution that starts next week, no conditions, no waiting for a loan on the buyer's part, no inspections to beat them up over, and you start making their next mortgage payment, that's music to a lot of sellers' ears. Okay? The seller's not necessarily desperate, but they've got a payment problem that they need to get rid of. That's what you're looking for. So again, the ads that say for sale or rent. Now, don't call up those people and go, hey, you want to do a lease option? They don't know what you're talking about. Again, the script. I have an excellent script on this in my lease options course you can check out. But you have to, do like every salesman does. Build rapport, get their trust, find out what the problem is, and try to solve it using one of the 3 techniques I have mentioned today. Okay? So that's lease options. Some final thoughts before we wrap up. If you're new in real estate investing, I encourage you to get educated. Not because I'm an educator, but because I learned a lot of things the hard way, the expensive way, and that's what we call going to a seminar. Going to a really expensive real-life seminar. I mean, you lose money, you write a check. It's much cheaper to write a check for the seminar or the training before. Like the Muffler Man says, you can pay me now or you can pay me later. As an attorney, I get a lot of pay me laters. And it's usually could have been all avoided if they knew what they were doing. Now, You can say the same thing pretty much with any business. You should always get educated and do your research before you go and venture in a business. But what makes real estate really unique is it's got a very high learning curve in the beginning. But once you get over that learning curve, you rarely make mistakes, as opposed to the stock market. Stock market is, we got geniuses running these brokerage houses and mutual funds, and they can't figure it out on a consistent basis how to make money most of the time. In real estate, you got a higher learning curve, but once you get over that learning curve, you're pretty much in charge. It's up to you whether you make money, not up to someone else, the market, or some other conditions in the Middle East that you have no control over. Because if you buy a house and realize you paid too much, then just hold on to it and wait. If you paid too much in repairs, well, then just sell it cheaper. If it's not worth what you thought it was, well, make it more valuable. Add a bedroom, paint it, carpet it, and landscaping. See, you're fully in control with real estate. The market could drop, yes, but it always comes back, and it comes back with a vengeance. And so you should also think about writing out a business plan. Whether you're new or experienced, once a year at least, write out a business plan. Who's your target market? What are your target properties? Who's your target customer, i.e. seller, buyer, renter, tenant? How you're going to market, your marketing plan is in there. And the numbers, how many houses am I going to buy, hold, flip, lease option over the next year or 2 years or 3 years, whatever it is. And that will give you a clearer path to your financial future than as if you just dabble. Dabbling gets you nowhere in real estate. I've seen it come and go. People come and go, kick the tires, try a few offers. It doesn't work, and they're off to the next thing, the next shiny object that comes in their email. It's not an easy get-rich-quick business. It takes work. It takes tenacity. It takes a good mental attitude. It takes getting educated, but it's worth it. If you put in 100%, you get 100%. If you put in 20%, you don't get 20%. So either you're in or you're out, but don't dabble. Don't be a tire kicker. Just decide this is for you, and if it is for you, then give it 100%. If it's not, then just don't do it. And finally, you really need to commit to massive amounts of action. And I'm not saying you have to work 80 hours a week. Some people can't do that. They have a job. So put in as many hours as you can, like a part-time job. Think of it as if you already have another job, this is a new part-time job, not a hobby, but something you commit to maybe 8 to 10 hours, 12 hours a week. That shouldn't be tough. Even if you're married with kids, you could squeeze in time there instead of watching reality TV shows or all the nonsense on Netflix. Put that aside and spend some time learning the business, doing your research, learning your neighborhoods, and practicing your trade, enhancing your skills. Abraham Lincoln, I think it was the one who said, give me 6 hours to chop down a tree and I'll spend 4 hours sharpening the axe. That's what you got to do. You got to spend the time to get over that learning curve so you don't make mistakes. Because you can make mistakes. You can't get rich in real estate investing quickly, but you can get broke quickly if you don't know what you're doing. So I encourage you to learn, to go to my website, take my courses, the free ones, the paid ones, and anybody else who's offering courses or books that sound interesting in your topic, whatever you've picked for your investing endeavors. This is Bill Bronchick. I enjoyed this very much. I hope you did as well. Make sure when you're done, you scroll on over to legalwiz.com, my website, and drop me an email, bill@bronchick.com, my last name, bill@bronchick.com, and let me know how you enjoyed it and anything that you think I might be able to do to make this experience better for all of us. Thank you very much.